Let's get the chat box. See who's coming in. All right, come on in. I got Chuck, Christopher, all the C's are coming in first. It's people lined up alphabetically, right? We're gonna have a good group here, probably 20 some odd people, maybe more. But come on in. As you come in, to get to know, who's in the room. If you go to the chat box and put your company name, what city you're in, and if you want to say something else like hi to everybody else, you can do that. Gar, I see you. Craig, yep, got some good people here. Gar and I go way back, multiple businesses, different times. So yeah, Robert, great. Do you guys, my panelists, do you recognize anybody coming in?
Kirk, I don't believe that I can see the names of the people coming in. Perhaps if I click this participants.
Yep, that's where it'll pop
section.
up.
Okay.
Yep.
That's disabled.
There it is. No, it's available. My apologies.
There you go.
Where are you finding it?
Out at the bottom of the screen now.
Yep.
Oh,
Under
here we go.
Participants. So if you guys want to drop anything in the chat box, if you got questions, the more interactive we are, the better, right? So let's. That's why we love your interaction, and we're gonna get started literally just at one more minute. Just give people a chance to log in. Maybe it's lunchtime for some folks and they're grabbing something to eat. Maybe, right? Just never know. So for those who are just now coming in, if you want to put in the chat box, if you want to put in the city that you're in, your business, anything else you want to say to the folks online, the more we interact, there might be some surprising information here. The better. And it definitely invites you to submit questions. There's a separate function in Zoom for Q&A, but you can use the chat box or the Q&A.
See if it's is it still locked, Kirk, or
Yep.
anybody else can get it in?
Yep. So we're gonna get things going. Okay. So let's launch. Let's go. Okay. So for the last several weeks, I mean, it's hard to believe I'm from Texas, but I do read. When I read the Economist, I read the Wall Street Journal, these whispers start, right, about a recession, right? We're already down. If you analyze the first quarter of this year, we're down 1.4%, on an annualized basis. So the whispering and the factors and all the different things going on, increasingly, different economists, different experts are saying, hey, recession's coming, right? And what's funny, when the four of us were preparing for this webinar, we had multiple sessions. And I asked Ramel and Sobelia, what are you seeing on the bank side from the CEOs that you work with? And they explained this kind of paradox, right? Where CEOs, we're optimistic, right? We start businesses, we do things that can't be done. So CEOs tend to see their business one way, but then they see the market a different way, right? And you're going to see that in the numbers when our economists here, the economic walkthrough that JP Morgan is going to take us through. And just before one of our sessions preparing, I was coming out of my 2% CEO mastermind. There's 5 of us. Gars is one of them, and we talked about this. And they, estimate your risk from 2 out of from 1 to 10. Where do you see yourself? And people were coming in on the low side, like 2, right? And I'm sitting here. I'm the growth CFO. I'm the economist. That kind of stuff. I'm thinking, man, there's so many things that are out of whack. My assessment is that the ripple is going to be bigger. It's not going to be an 8, 9, or 10, but 5. Where if you consider the labor market, supply chains, all the money that we put into the economy, and we're back at war in Europe, right? And that's there's a lot going on there. So the last recession, it was more than a 2 out of 10. Right, GDP dropped by 4.3%, but at the same time, things are different now. I mean, we went through a whole pandemic, right? And so things are different. So as you get into this, I mean, definitely submit your questions, Q&A, and if you want to chat back and forth, use the chat box, because there's 4 of us, so there should be at least 3 of us who are interacting with you in that manner. So. Let's get things going here. We're gonna really pick up some momentum and get into this. So it's something like this. Remember when you started your business, you're at that starting line, and now you got your company going. So maybe it's something like this, where you may not be the leader in the pack, the biggest company, but you're probably in the pack somewhere up front. Probably a lot of the CEOs that we work with, they don't want to be the biggest, they want to be the best, right? So your business is going, you're running, right?
We're not seeing the slides.
Oh, the slides aren't there. Let me relaunch that. I apologize.
Technology is just great, right? There it is.
Yep, you got it back.
There we go.
Okay, and just to ground us, these are the panelists, right? You can see where we're all from, and let's get going here. So at starting line, we're taking off. You're running, and just to restate that, hopefully you're in the front of the pack, right? Maybe not the biggest company, but probably the best in what you do, and doing well. The money is good, or at least the money is okay, right? You definitely, hopefully you're not in the back of the pack, right? It's difficult back there. It's usually every day is a whirlwind, and there's cash problems, there's people problems. It's if you're, for a lot of people, if you're in the back of the pack, you start questioning life, like, why am I doing this? Right. And since we entrepreneurs are more optimistic than most folks, we look ahead, we see a hurdle, it's just one hurdle, so we jump it, right? And it requires effort, but we do it, right? We do it routinely. And your accountant is not going to see the hurdles the same way you do, right? Accountants see that same hurdle that you're leaping over. For them it's tall, right? They might even say things like, about not doing it, or play it safe, and that kind of stuff. So the reality is probably somewhere in between, right? The optimistic entrepreneur versus the task-oriented accountant that wants to play it safe. The reality is probably something more like this, where in business, there's many hurdles, there's competition, there's team members, and most of us are caught up, most team members are caught up in that day-to-day. Most team members, even managerial and leadership team and your partners, most people think status quo, like tomorrow is going to be the same as today, and today's more or less the same as yesterday. And they don't see things coming with foresight. It's just not how most people operate. Even when they do planning, the view forward is just very limited, like turn out the lights and lots of blind spots kind of stuff. So think about your team, right? Do you have all the seats that you need? Are you working on your business in a manner where when things come up, like it could be a recession, or like the COVID did, not too long ago, do you have the right butts in seat to do really well? And so, John, remind me of the story of one of your clients.
Yeah, well, we had a most recent exciting time, of course, when COVID landed, and it's a similar kind of environment. You don't know what's coming. There's a lot of uncertainty, and there's confusion. So one of those companies, we had a distribution company, and we had just finished our scenario development for the future, or future planning, make a flight plan. We had the best case and the middle case and the worst case. And the worst case involved, okay, what if this oddball little germ shut all the commerce? What happens? And we had written out a scenario for that. And 2 weeks later, the governor shut down the state. And they were able to pivot right away and didn't have to think about it. We'd already pre-thought a lot of this stuff. And they're still in business. They lived through the great COVID reset because they had thought ahead and planned ahead, which of course is the purpose of this webinar, is to kind of do kind of the three key things, which is evaluate. We're going to get good information today, right? And then create multiple scenarios, then make a flight plan for each one, so that when something stressful hits, you're already pre-thought. No need to panic. Just pick a course. That's kind of our lesson.
Yeah, and literally, that client was right in the crosshairs of everything that was being shut down, like completely. So there can be three takeaways from this webinar. One is evaluate. Two, run scenarios. Three, draft a flight plan. Okay, and then with that, so before we figure out what happens next, let's get a real solid footing on the current state of the business. And so this is our runway. This is where we're at for takeoff. And Romel's going to talk through the current economic conditions, and then Sobeya is going to talk through the bank recommendations. What can we do better to whether recession or no recession, have things in good shape. And I believe, Romel, you got to say some disclosure so that the bank is happy with you. Is that right?
That is correct. So Sobeya and I both work for JP Morgan Chase. I'm executive director in the middle market banking and specialized industries group, and she is vice president with the business banking team. And we have to acknowledge that any opinions expressed today by either of us are our opinions and not necessarily the opinions of JP Morgan Chase. We will be sharing some data that comes out of our survey today. That's just data. It's raw statistics, and are happy to share that with you. But obviously, our opinions are our own. And with that, I guess we can get it kicked off.
Yeah, we're gonna move fast. So they're gonna take us through that part. Then John and I will come in behind, and we're gonna show you those 3 takeaways and how we go from jumping hurdles to a smooth flight. So it's all yours.
Well, so first of all, Kirk, I think you did a great job of kind of capturing some of the things that we've been talking about over the course of the last couple of weeks, and highlighting some of the dynamic things that are going on in today's economy. And I'm sure everybody's concerned, but also looking forward, right? And there's some really interesting things that don't necessarily reconcile easily. So let's talk about some of those things. So the JP Morgan survey results give us a really interesting story here, where business owners are both becoming far more pessimistic than they were a year ago about the national economy, but far more optimistic about their own opportunities over the course of the next year. So 19% of business leaders are optimistic about the national economy relative to 75% 1 year ago. And then pessimism is up to 51% versus 10% a year ago. What are they pessimistic about? They are concerned about labor shortages. So 11 million job openings as of May 2022. And this is interesting because this is actually a long-term trend. While a lot of people will attribute it to an accommodative monetary policy and aggregate demand increasing throughout COVID and after, this is actually a longer-term trend. Many business owners, 86%, cite higher inflation compared to 6 months ago. And of course, interest rate risk is a big concern for them. With that said, 83% plan to grow their business. And this is an interesting one. So if 83% of businesses are growing, then the economy is probably going to do okay. But I think what they're really thinking is that here's an opportunity to take advantage of competitors who are experiencing obstacles. So I think you touched on this earlier, Kirk. The accountants look at the hurdles as something that's difficult to get over, and the entrepreneurs say, "Oh, that's great. I'll run through that one or over that one, and we'll be just fine." And I think this is frankly good news, that entrepreneurs remain optimistic about their ability to persist despite what's going on with the national economy. So let's jump to the next slide. So here is a picture, is a graph of job openings throughout time, so over a 10-year period. And what you really see here is this long-term trend, and Sobeya can talk about this a little bit. For the last number of years, when I've been talking to my clients, I say, well, what's the number one thing that keeps you up at night? What's your number one hurdle? And candidly, what they say is finding good people. I have a manufacturer who's got plants all over the world. We were on the phone yesterday, and they said we just can't find enough people up in the thumb area of Michigan to meet the demand. And so this is actually a long-term trend. You can see that when you look back to January 2012, and you look out to January 2020, you see this slight downturn in 2019, and of course, once COVID hit, you see this big drop. And in response to fairly accommodative monetary policy, you see this big uptick. Obviously, a function of the PPP, employers had to maintain a certain level of staff, and then when aggregate demand really came back rushing in, you see this big uptick in job openings. And I think what we're really experiencing is kind of dislocation of our labor force. So there are people who have skills that don't necessarily reconcile to the skills that are in demand. So if you think about cybersecurity, software developers, those kind of jobs are just really growing at a really fast clip, and we're not producing enough software engineers to fill those jobs. We're not producing enough people with clearance and so on. And so this might be a protracted issue that employers will continue to have to think about, and frankly, as a country, we may have to continue to address. And by the way, if anybody wants to interrupt me as I'm going through some of this stuff, don't hesitate. And if any questions pop up, I'm definitely happy to answer those questions as we're going through the slide presentation. We can tick to the next slide.
Well, Ramal, I've got a question on that one. Do you think the recent interest rate and rises that the Fed put out is going to slow the economy down enough that we're going to continue to see more openings? Do you think it's going to fall back? The right side of that little arrow just peeking down a little bit, that chart.
Yeah. So, this is interesting. That's a great observation about the end of the chart. I think the end of the chart is illustrating exactly what you're pointing to, is that interest rate increases, frankly, the short spike in oil prices and what's going on with the Russia-Ukraine war have signaled to employers that a recession might be coming. And what you're seeing is that employers are starting to say, okay, perhaps we should scale back a little bit, right? And I do think that our monetary policy will cause some scaling back of hiring, at least temporarily. Recessions create kind of a deflationary environment. The interesting thing about that, though, is usually once we're in a recession and it's obvious and inflation is no longer an issue, we get more of an accommodative monetary policy, and that kind of staves off the deflation that we would experience. So I guess that's a short way to say, yes, I expect that the job openings will come down if the Fed is afraid that we might push ourselves into a recession and it is too impactful. Monetary policy could go from hawkish to dovish, and you could start to see that ticking back up.
Yeah.
Just to opine on that a little bit, there's also a social cultural norms that are also impacting that. I mean, when we talk about the labor market, I think we also have to talk about what's happening. We have the Great Resignation. We have a lot of social cultural norms that are taking place right now in this environment where there is a lot of volatility on markets. So I think it is going to be a very interesting time for the labor market. A particular measure that banks and just overall employers are looking at right now is the underemployed market. You're finding that that's about 22.8%. So that means there are people and jobs that shouldn't be in those jobs, that they have higher skill set. So the other thing is going to be for entrepreneurs creatively being able to collect that information accurately up front when you're interviewing someone. Hey, does this person have additional capacity that could be used or leveraged in another part of our business? And that is going to also change this a little bit. I think it'll skew the numbers from as far as some of these job cuts, because if we become better at finding talent within the organization that can be properly utilized, then you don't necessarily need another 40-hour requisite open. So that's something to consider as well.
Yeah, very good.
Yeah, I completely agree. I think that how we use the talent that we currently have is gonna be impactful as it relates to the Great Resignation. Obviously, to the changing behavioral patterns, a lot of employers are finding it difficult to get people back into the office. Where Sabia and I work, we are a 3-day work week in the office and 2 days at home. And candidly, I think that is somewhat of a compromise between the aggregate desires of the labor force and leadership, who really wants to see people back into the office. And these will be things that employers use to attract talent, to say, hey, we're going to offer you more flexibility. We're going to do these, offer you obviously more opportunity, and maybe even the opportunity to build your build your skill sets horizontally. as people are looking to diversify the tools that they bring to their organization. But great point, Sabia. We can tick to the next slide. So this is an interesting one that touches, John, on to your question earlier. Part of our unemployment rate being so low is a function of the fact that the labor force participation rate has not only been dropping since about the year 2000, but it also dropped precipitously during the pandemic. And this is, at least personally, this is concerning to me. The labor force participation rate is dropped, as you can see, from about 65% 10 years ago, and it hovers around 62.2% as of May. And the labor force is about 162 million people. So that 3% delta is pretty significant. And again, I don't necessarily believe that if you brought those people back in, that they'd all match up with one of those 11 million jobs, because I do think that there's some dislocation in between skills and labor force demand. But this is a pretty interesting graphic about how our labor force has changed and the level of participation over time. And I'd be hopeful that we at least get back to our pre-pandemic levels of about 63.5%.
Yeah, we're seeing a real flip. It used to be like there's basically 5 obstacles of growth. It used to be getting new clients was the number 1 obstacle, and now it's flipped where it's people capacity. And there's more than a handful of business owners who have plenty of customers, plenty of sales, but they literally don't have the people to meet that demand. And it's coming to the point you got to choose who you're going to serve.
Yeah, that's right. And, if you think about it, that creates some inflationary pressures as well, right? And this is a long run problem, and you can see that in these last 2 charts. And obviously, whether we're in a recession or not, especially if you're hiring skilled labor, this is going to be something that you have to be attentive to as a business leader. So we can tick to the next slide. So Jim Glassman is head of economic research for the Middle Market Bank at JP Morgan Chase, and Ginger Chambliss is, Jim Glassman is the head economist, and Ginger Chambliss is head of economic research for the Middle Market Bank at JP Morgan Chase. And on June 7th, they published an article, Economic Trends to Watch in the Second Half of 2022. So this slide here and the next slide will highlight some of those trends. Keep in mind that this was published June 7th, and so maybe some things, there are some slight differences. I don't think so, other than the purchasing power, which is in brackets, because that's not the number that they use, and I'll speak to that. So they started with this opening. A lot of people were concerned with roughly 9% inflation is the only tool that we have to solve that kind of Volcker era rate increases until we stamp out inflation. And in short, what the article stated is that no, that's not the only tool. In fact, inflation in this environment is primarily a function of supply chain disruptions that are over time solving themselves. And so there are a few things that are working in our favor. One, that we've seen the 70s and what stagflation looked like, and what the monetary policy at that time did to contribute to it, right? And so the current Fed is paying close attention to that and trying not to repeat the past. But 2, aggregate demand for oil has dropped, and we've seen a drop in oil price from about $130 a barrel to, I think it's roughly $100 a barrel today. That has had a flow through effect into gas prices, which I think were 30 some odd days consecutively decreasing. So that's good news. But here's the other good news. Excuse me, our Fed has been, I'm sorry, I may be skipping ahead here. I'm looking at the slide and making sure I'm on topic here. I'll I'll touch that on the next slide. The Federal Reserve is still forecasting natural rates being somewhere between 2 and 3%. So through the course of the year, they show their projections for what the Fed funds target rate should be. It can be as high as 4% from there, based on their projections, but the long run expectation is 2 to 3%. So that's good news. Mortgage rate increases have put a damper on housing affordability. So at the time that this report was produced, mortgage rates had increased about 200 basis points or 2 percentage points, and that had dropped affordability to about 22%. At this juncture, I think mortgage rates are up about 2.5 to 2.75%, and that is decreased home affordability about 30%. Now that should slow down the inflation that we see in the price of housing, which should also impact to some degree rental rates as well. However, there's still a shortage of housing in the United States. So I think Freddie Mac last year had said that there was about 4 million units short of what was demanded, and it would take a number of years to solve that. So the price slump probably does not slow down residential construction, and so we'll still see some likely some resistance there. Again, they expect that inflationary pressures will ease in the second half, and if you look at the Fed Reserve, they're forecasting a median inflation rate of 5.2% for 2022. And if you know where we stand today, you can imagine that means that headline inflation in this case is coming down quite a bit from their vantage point. And for 2023, 2.6%. And these are the numbers as of the June 15th meeting. Now, the big caveat is no one knows what will happen with the Russo-Ukraine war, not just the conflict itself, but our role in the conflict. I know in our conversation early in the week, one of the things that came up is food insecurity for many of the countries that Ukraine and Russia export food to. So the Middle East and Africa are frankly very concerned. And while our sanctions do not include a prohibition on purchasing food from Russia, there are countries that have already preemptively done that. And so there are certain African countries that have petitioned the G20 to not do that because it creates a spike in pricing for countries that rely on food from both Russia and Ukraine. And this is still something to watch, however, probably not likely to have a material impact on our economy. So we can flip to the next slide. So other trends to watch, and I almost jumped into the currency section in this slide, in my last slide. So apologies for doing that. But I thought this was pretty interesting. So our Fed has, while a lot of people have been critical of the fact that the Fed has been kind of behind the curve on addressing inflation, initially saying that it was transitory, it was not a long-term problem. I think Jay Powell a few meetings ago said, well, we were wrong, right? So they began tightening. But what's encouraging is that our Fed has begun to tighten ahead of many other central banks, and that's caused our dollar to strengthen pretty substantially relative to other currencies. And what that means is that for imports, those imports will cost less, and that could actually have a positive impact on pushing down inflation to the tune of a full percentage point in the second half of 2022. So good news. You know, a lot of people have been concerned that the Fed has moved too slow, but apparently the Fed has moved faster than certain other central banks. And on the markets front, investors, you know, have been anticipating this and have included in their expectations the removal of monetary stimulus. And so you see that in the public equity markets and frankly, public debt markets as well. But at the same time, companies at this juncture remain very profitable, primarily benefiting from learning how to operate leaner processes during COVID, and really not picking up the additional operating expense that they had prior to COVID, but still picking up the additional revenues. So you've seen a lot of companies operate more efficiently. And of course, the way that that's getting picked up at times, perceived at times, is that it's simply because of price increases, but it's not in fact just because of price increases. Many companies have done a much better job of operating more efficiently in keeping operating expenses low.
Yeah.
Ramal, I think that's an interesting point. As an entrepreneur, how do you manage your efficiency ratio? How do you set a target for that, for what that needs to look like?
You know, this is an interesting point, and I will concede that efficiency ratio is something that banks look at a lot. I don't know if every business refers to it the same way, but essentially, you know, how much does it cost you to make a dollar, right? And Sabia, you and I both get to see this in some of the businesses that we work with, but many of them found ways to use technology and just streamline operations during COVID that they didn't have to think about before. And because they were forced to think about it, they came up with solutions, which is what entrepreneurs do all the time, right? And they came out of that, and these their operating expenses, or their operating margin went up, right? Their operating expenses went down. And what I think, and I don't know this to be a fact, I just from anecdotally from observing a number of businesses, what I think is that efficiency ratio, or their operating expense relative to revenue, or whatever you want to call it, I think what they think is appropriate has probably changed, and it's probably lower than what it was in 2019. And I think that will bode well for being prepared for a contraction in revenues in the near future if that happens.
Yeah. I think it's worth highlighting that genre where, you know, the pandemic did force a lot of people to wake up and see things differently, and maybe get rid of products or divisions that aren't producing, and you know, C player employees. So that, you know, that going into whatever's going on now with the economy, whether it's just one quarter down or multiple quarters, you know, that, I don't know, that lean, that cleanup, that more focused CEO is going to be more ready for whatever comes next.
Yeah, I completely agree. And, you know, I think there are a lot of reasons to be optimistic about how prepared we are across industries and our banking system for a possible recession. Banks are much better capitalized today than they were in 2008. And what you saw with the savings rate, I think the savings rate peaked around 30% during the pandemic. I think it's down to about 7% now. But what you really saw is, you know, deposits at banks going way up. And while that's coming down a little bit, I think a lot of companies were able to rebuild their capital structure and make sure that they have sufficient cushion for downturn. Yep, sufficient liquidity for downturn. So, and I won't jump into too much of that because I know, Sabia, you're going to be covering some of that. So we can tick to the next slide. So I just thought this was an interesting graphic here. This is the Housing Affordability Index, and it shows you what, you know, a year ago, what housing affordability was like relative to today. So about a year ago, it was about 150, and today it's at 107. And as I understand it, the Housing Affordability Index, or Housing Price Index, started in 2008 and looks at the pricing of the price of housing, the same house, you know, as it sells over and over and over, how affordable that is for individuals who are using a mortgage to purchase the house. And what this really tells you is that affordability has gone down precipitously as a function of rising interest rates. And so you would anticipate that demand, aggregate demand will decrease. Nevertheless, supply is still constrained. And so pricing itself may not abate in the way that it did in 2008.
Yeah, it's a different world. I mean, almost in a lot of ways, it's so different. It's more challenging. I mean, it's just a lot of different moving things. I don't, I'm in agreement. I don't see tsunami. I just see, I see hurdles.
That's right. That's right. You know, one of the interesting things about that I always think about our economy is that it is both dynamic and complex, but flexible, right? So we benefit from it, but there is more to understand about it. And to your point, it's a different world. It's even more complex than it was in 2008. Um, but it offers us a lot more tools to figure things out. You know, you just think about if the pandemic had hit in 2008, how many businesses would have been prepared to send their employees home and continue to service their clients. I don't think it would have been remotely the same as what it was in 2020. So
Yeah, big
good news.
difference.
Yeah.
Yeah.
Uh,
So let's get into recommendations. How does the bank see the world? What should we CEOs be doing?
Well, from a CEO and a CFO perspective, the biggest thing I would always say is you want to always have the bank at the table, right? When we're talking about strategy and discussions, there isn't a client that I work with that I don't understand their P&L, their balance sheet, the cyclical nature of their business, if there is one, the seasonality component. So I would say start there. That's one thing to from the forefront reconsider. How do I approach the relationship with the bank? Do I have a relationship with my bank? Because the bank wants you to be profitable, right? Because the bank earns your business that way. So one of the things that we're always focusing on with clients is balance sheet, right? I call it the fortress balance sheet, right? That's where it starts. Whenever I have any type of request, whether it's a merger, an acquisition, a buyout, an expansion, commercial real estate, the first thing I look at is the balance sheet. And that gives me just a snapshot of how the business is doing. And, the saying is still the same, right? Cash is king, right? So liquidity. And Ramal touched on that a bit as far as just making sure that you have a good capital structure, what that needs to look like. And, if you have the bank at the table, the CPA at the table, we're going to be talking about industry standards, what that looks like for your particular industry. So again, strong balance sheet. The other thing that I always want to talk through with clients is covenants. If you have any type of credit facilities or outstanding loans, what are those covenants? Because in times where there can be any type of volatility, whether it's top line number or bottom line number, we need to be aware of what those financial covenants look like because they can result in the loan possibly being called or just out of compliance. And those are scenarios that we don't want to be in. They're not good. So again, making sure you understand whatever credit you have, what are the terms that correspond with such facilities. And then this is back to my first point as far as strategic partnerships. Kirk hears me say this all the time. And Ramal too, we have accounting backgrounds and degrees here, but an accountant is typically there for one particular part of that strategy, right? As far as the forecasting, the modeling, that's going to really be your CFO, and then your other partners that are supporting, investment activities, business investment activities. And one of those partners is typically your bank, right? In the form of access to capital. So
Yeah, that's a great point. I mean, the smart money in all scenarios is proactively get access to capital and have a close, invest time and effort on a not continuous basis, but a periodic basis with your bank to make sure they know what's going on. Makes a huge difference.
I would say at least once a year. If you're experiencing volatility or there's some concern, then that needs to be probably quarterly. Specifically, also, if there are any type of credit facilities outstanding. The last thing as an entrepreneur that you want to happen is you have an annual renew and all of a sudden access to capital that you thought you would have, all of a sudden you don't have because the financial statements don't necessarily support for that type of exposure.
Yeah.
But
so
if we're yeah.
Oh, I'm so sorry. I just wanted to highlight something. I think the most visible example of this is during the pandemic, there was a lot of concern that banks would not fund under some of these large corporate credit facilities. And so you saw companies like Boeing draw down on their $9 billion credit facility, which I think is a really good example of what you're talking about. So for fear that wouldn't be available, Boeing drew it down and put the cash into their account.
Exactly. And we'll probably see a little bit of that, but the environment is different than it was in 2008. Your banks are having annual reviews for a reason. A lot of the credit facilities in the form of revolvers, they're borrowing based, right? The banks want to see the financial statements sooner rather than later and more frequently. So again, be transparent. Your banker is going to give you a path forward, right? And that path forward is essential. Whether it's the exact path you want or not is a different question, but it's a tool that will allow you to plan, right? To create fourth options, to create, you know, or as Kirk says, to get through some hurdles
Yeah.
and to be prepared for those. Uh, and just transitioning to the next slide and topic as far as greater access to capital, that's going to be the same thing, and that relationship with the banker, because your banker is going to be able to do a cash flow analysis, really analyze your business, and whatever the business can support, we're not going to say no to, right? We understand the need. We understand where the capital is going to go. It's going to go into investment activities. So having those conversations, also having someone, whether it's in the finance department or a controller that really understands debt service coverage and what banks are looking at, that's also important as well.
Yeah.
With
That's-
interest, yes,
Yeah,
yes,
that's
Kirk?
good. Just for time, so we land on time. We're going to send these slides out to everybody, right? And there's on the back side, there's a checklist, a flight checklist, so that they'll have all the advice. Cool. So I'm going to step on the gas. You ready? Okay. So now for the three key takeaways, right? So here's number one, right? This is working on the business, right? It's a good practice no matter what's going on in the economy. Can you see it where you got your the best practice is to huddle with your leadership team at least every quarter, right? Step back. You're not in that whirlwind of the day-to-day and look at the business. And some CEOs like to do it offsite, others like to do it on-site. The main thing is turn off your distractions, right? Elevate your thinking. You'll get out of the the task level stuff into what's really going to drive outcomes in your business, and go through it, right? Evaluate your market trends. In the 2008 recession, could be a model. What impact did that have on your customers, on your employees, on your investors, your suppliers, your banks, your competitors, others in that ecosystem that you have? Look at 2008 and then think about what we just went through. What's different, right? And how might that play out, right? And no matter what happens, even if it's a bull market, you're going to be better equipped with that scenario. The third thing we'll get to. So definitely think through all those different pieces, and from that you put it all together, and you got a forward view, right, on what is likely to happen. And the second part, so you have these these non-quantitative aspects of your business, the trends, that kind of stuff. Put the numbers to it, right? Literally, thing number two is run scenarios, right? You got that forward view, put the numbers to it. The best practice is a 12-month rolling budget. The really best practice is if you have a multi-year financial flight plan, so you can see where does that first year, where does it get you across 3 to 5 years, what value in your business, what profitability you have, what household income do you have. That's when you're playing chess versus checkers. But at a minimal, do that 12-month rolling budget where you can take your different options, your different scenarios, and what if, right? And what typically happens, you probably heard about the Pareto rule, right? The 80-20, where 20% of your activities drive 80% of the results. Typically you do this and you find out there's like literally 1, 2, or 3 leverage points that really drive outcome in your business. Well, focus on that. And the same with your customer segments, right? They're not all the same, right? There's some customers you might want to prune, right? And there's
Financial modeling.
Yeah, your top segment are the ones you go after. So doing this, the clarity of the numbers, most CEOs that we work with, they're not numbers people. They don't see the numbers story, but you have the right people at the table and you'll see it. And it's stuff that you can act on to get more clarity, more confidence, the better results. And so the third thing, John's going to talk to about the third thing, drafting your flight plan from the first two things that you did.
So I think information like we just got from Sabia and Ramal is really helpful to kind of see the big picture. If you think about a flight plan, there's many factors that keep the airplane in the air. You have fuel, right? Is there a storm coming? Where are you going? Cold or hot? So there's many factors. And that's one of the things that making scenarios, you have to consider all the different factors. And the more people you have at the table, like Sabia said, the better off you are. So the first one, let's take that next slide. So here's the things you think about in your flight plan. We're going to go through them real quick, and we're going to send this checklist out to you. So one of the first things is win and keep existing customers. New ones, keep the old ones. When things get tough, people start to move the chairs around on the Titanic, and you want to make sure that they move them into your lifeboat. So let's keep an eye on that. And as Kirk said, also, sometimes you might want to prune the non-performing customers. It's time to clean house, but don't lose track of the customers. A company I spoke about earlier, their goal was to sell their way through COVID. So they added to their sales force, even though their revenue dropped 25% in that first month. They got it back and more when we finally came out of COVID in January this year. All right, talk about the next ones. So this and Sabia and Ramal both talked about this. Value in your workforce that sometimes you can take for granted when there's a lot of people just knocking on your door and need a job. You don't have to actually invest in, work with, or develop your workforce. But there's a real asset in your workforce if you manage them correctly. So they need a flight plan, an individual flight plan, if they're working towards something, they're working a lot harder than if they're just working for a paycheck. Managing, adding, investing in your workforce, not just throwing money at them, but actually finding that underemployment 20% that somebody mentioned. So this actually is your secret sauce for every company at this point.
Yeah, that's the number one obstacle now, is that people capacity. Like we said before, it flipped.
Yep. All right, and this is where you be friends with your friendly neighborhood banker. And then say, would you like coffee or a donut with that? Because the time to meet your banker is when you don't need the money.
Agreed.
When you're out of working capital and your suppliers jack their prices and all of a sudden you're not going to make payroll, that's the wrong time to call the banker. The right time is right now. And talk about the 3 or 4 scenarios you're doing. Talk about the kind of get some input. This is great input. This macroeconomic insight the banker has for you. They can talk about your business, have that discussion going with your finance team. And that way, when something bad happens, they can trust you. If there's the numbers tell the story, but beyond that, you lend to people, because the people who know what they're doing and can see their way through, those are the ones you're more likely to lend to, the ones that just have a big bag of money or a big spiel. So build those relationships now. Part of the flight plan. Okay, and vendors and suppliers. In times of turmoil, victory goes to the prepared. So look at your vendors. Are they? What's their bench depth? Right now, so the first thing on the pandemic that got sold out was toilet paper, right? So do your vendors have what you need to survive what's coming? And we don't know what's coming, but as you do a check, make a grade list, 1 to 5. Who's my strongest? Who's my weakest? And find backups. If you think someone's going to go out of business, you need a backup right now, and you need to take that person to coffee. And I make sure that you've got a fallback position, especially if someone has to double their prices. What will you do? Where will you go? Because you can't stay with that person because they can take your money right out of your pocket. You have to go find someone else. And so all this kind of preliminary thinking and planning, not too much of it, but just enough that you're not surprised when something bad happens. Okay, and then the fundamentals. This sounds like your coach at the gym, right? Do 10 more push-ups. So instead of just checking your financials and putting them in the drawer or the outbox, you have to sit down, look through your financials, make sure your stuff is categorized correctly. Use your 12-week cash forecast, so you're not surprised if it's a jump in cash for something that you didn't plan on. You should look at and discuss your financials with your leadership team. so that people notice trends are creeping up. This cost is creeping up, or that cost is creeping up. These habits, it's something you can get away with when everything's flush. You can get away with kind of being lazy about your financial habits, but this is the time to double down and make sure that you're ready to go, and have your emergency pack all packed here, where you know what's going on.
Yeah, I mean, John, all those things, the financial forecast, the budget, the engineering your way forward, it's all about clarity, right? So clear decision making with confidence, clear follow through, and so it's not a bad way to go.
It doesn't guarantee that you'll be successful, but you'll have the best information available to make really good decisions when things happen quickly, and that's the goal. Give you options when stuff hits the wall.
Yep, and it's just to keep hitting this point home, because there's lots of role confusion out there. A lot of CEOs think that if it has a number in it, the accountant can do it, but it's running a machine, processing transactions is very different than engineering a business way forward. So accountants get tripped up with this kind of work, right? Accountants are rearview mirrors up to your financial statements. So the three things are evaluate, 2, run scenarios, 3, create that flight plan. And when different things happen, you pull it out, update it, and execute. So you're always doing well. Doesn't matter if it's a bear market or bull market, right? You got options. So this is growth CFO work. And I'm gonna bring us into a landing here. So we're going from hurdles to really a smooth flight. The growth CFO is a person that CEOs love talking with. They're, growth CFOs have a proven approach to gain momentum going forward. But it's not cookie cutter. I mean, every CEO, every business, there's differences. I mean, it's amazing how different the differences are. In our case, we work in 3-person teams. We go well beyond the comfort zone of any one person. And our responsibility is to ensure that CEOs have the financial resources to do well, right? And we protect the downside by eliminating many surprises, if not most or all. So most CEOs have an empty seat at the table doing this type of work, but it's a game changer, right? It really makes things happen. So coming in for the landing here, if you're ready to talk about the empty seat in your business, let's schedule a 25-minute huddle. If you go to the website, Foresight CFO, there's a button there, book a 25-minute call, you hit it, pick the time that works for you, and we'll rock and roll together. If you're not ready, I encourage you to read our book with Forbes called The Growth CFO Void, when it's released on September the 27th. Can you believe we're waiting for paper? We had to wait from June to September for paper.
Supply chain problem.
Yeah, but it's ready. It's ready to go. So it's been a pleasure having you all on the call today. I hope you got something that's really useful to you. The slide deck is going to have everyone's contact information on it, and so if you need to contact our friendly bankers here who've been a great help to us in different situations. And the one thing you definitely want to do is read these disclosures in detail before you do anything else in your life. And that I'm being right. So that's a wrap. Do the panelists want to say anything before we shut things down?
Thank you for the invitation, Kirk. It's been a pleasure.
Yeah.
Likewise, Kirk. I want to encourage all the CEOs on the line to follow Ramal and myself on LinkedIn. There are a lot of business seminars and resources that JP Morgan Chase is extending to entrepreneurs. We just had our first business seminar since the pandemic commenced here in DC this week. So we are also adding not just what the bank has available, but industry specialists and consultants. So I want to make sure that everyone has access to those resources.
Great. John?
I think that's right. But one thing, it's not just the disaster we're preparing for, but also opportunity, right? When there's downswing, there's also inexpensive moves you can make to actually grow your company in the bottom. That's the ideal.
Yeah, that's a good point, because if there's a recession, wages are reset, cost of things are reset. If you got a war chest of cash and you got a plan to execute on, you'll do things really well. And so, hey, thank you. I can't wait to see everyone again on the next event. So see you soon.
Thanks, everybody.
Bye.